Good morning or good afternoon. I always get that wrong. Good afternoon, everybody. Welcome to our 6th midday on a Monday, brought to you by the Buzzcocks Corporate Finance team. Day 42 of lockdown, so on the bookshelf thing when I was looking for it just before, just in case. Don't want to give away the punchline, but if anyone hasn't read it, Life, the Universe and Everything, the answer is 42. Anyway, so day 42. Our 6th midday on a Monday. In most years this would be a bank holiday, but not this year, as we have a bank holiday Friday. So another unique thing about 2020. So cracking on, because we're trying to keep this to our new condensed half-an-hour format. What have we got lined up for you today? Well, we've got myself. I'm going to have a very quick talk through the new norm. PJ is going to give us a Sybil's update, and then we are launching this week our Buzzcocks Sector Valuation Insight Report, which Andy, Mira and Hamish are going to talk through. I'm not going to steal their thunder at this stage. Need to say it's got some really interesting outputs, and so they're going to have a very quick canter through the outline of the report, as well as share some of the specific details that the research has highlighted. So onto the new norm. One graph for me this week, not a very exciting graph. Hopefully you can all see that. This is the FTSE 100 for better or for worse. Whether it's really a proper indicator, my jury is out. It's got lots of oil stocks in there and stuff like that, which has funny even more different effects, but I think what one can see in there is rewinding back, is if you can see you probably can't see the very small print at the bottom, back to the when we first did this at the I think it was the 22nd of March, or maybe even 16th of March was the first day we did this. The FTSE was down in the doldrums, having come off a high of sort of 7.5, nearly 8,000, down to 5 and a bit thousand, dropping right down to into the 4,000s. Now we've bounced back, but now we're heading back the other way. As I think the reality is heading in about this new norm, and that I think as the Italians have put, as they've all come out of their sort of hibernation today, and I think formally, and have headed back to work slightly more formally, it's about learning to live in parallel to the virus, not live a different way or back to the old way. So in terms of where we are, on the new norm, and I'm a bit disappointed, because I thought this week, I might be allowed to play golf or something like that. So I was all hoping Boris might say something last week, but obviously, sadly, things haven't quite got back under control as quickly as we would all like. But obviously, I hear that this Sunday Boris is going to address the nation with what the new roadmap is going forward. And I suspect, again, if you look at the Italians, the Italians already complained they've got a very, very complicated roadmap. But they're going to be big challenges going on. And so as for the government and that new norm, very simply, they've obviously put out a whole load of support there, but my view is they've started on that support, so they're going to have to finish on it, and they can't just give up halfway through. And so almost inevitably, and we're going to find out, the government are going to continuously be on a 30-day cycle on the coronavirus job retention scheme, because there needs to be for the large employers, there needs to be a 45-day statutory redundancy notice given, which is obviously for the end of June. Is going to start clicking in on or about the 15th of May, maybe the 16th of May this month, as it's got a few extra days. So there's going to be that cycle. So the government are going to have to keep on looking at renewing it and evolving it, and they can't just stop it. And to be honest, I've got several clients where if they stop it in June or July, they're probably going to be screwed. So they're going to have to keep on going. I think CBILS, PJ's can talk about CBILS, it still needs refining. And again, that is going to be something just like the scheme back in 2009-10, the finance guarantee scheme at CBILS is going to keep on going, but it still needs refining to make it work. Also, I think we're still going to be, we've had some, obviously the VAT hot deferment, but I still think there's going to be more direct cash injections are going to be needed as we go on over the next few months, because there's going to be big changes. There's going to be a new lines as such, where even talking about, I think just this morning, no more hot desking. Okay, that doesn't really change the way that we work at Buzzacott loads, but it is going to change the way that people interact and work in businesses. And there's going to be, and I think as every day goes on, it shows how challenging it's going to be for people to get back up to that, if I get my hand in the screen, to the line where they were. And the new norm, sadly, is probably going to be for a period of time lagging behind that. But I'm sure the government will be doing things to help. And inevitably, I think I read that they've cut VAT on PPE for the next 3 months, which seems a very wise move. I'm sure that there will be, just in the same way that we've got R&D tax credits and film tax credits and all this sort of stuff, that there will be tax credits or tax relief for helping make workplaces more socially distant, to encourage and to support the employer in doing that. So that's all to come. But this is going to be a whole new roadmap we're going to get, which will set out the way. And finally, that's all going to be paid for, ultimately probably by higher taxes, because the government can't just continue printing money ad infinitum. So that's my bit, my thoughts for the week, shared without any quizzes or anything like that. So I want to hand over to PJ, who is going to do his weekly, for the 6th time, weekly update on CBILS and where we're at, what might be new. There's some new loans as well, which are sort of distant cousins related somehow, but I'll let PJ take over. So over to you. Afternoon, PJ. Afternoon.
Thanks, Matt. And I've got my microphone off mute this time, so I've done much better already. So there's been a much better uptake from the banks, but there's still quite a lot that needs to be done. As at the 30th of April, there were 25,000 applications that have been successful. It's 4.2 billion that has been lent through CBILS. So put that into context, it's about 165k per loan. So it's still on the small side. So a lot of people are looking for bigger quantums, but those don't seem to be coming through yet. There's been, something that probably will help. There's, plenty of new lenders now who are accredited, and the likes of Allied Irish Bank, Funding Circle, Starling Bank, etc. These guys are all out there now, concentrating on CBILS and getting that into the hands of their portfolio clients. I've spoken to some contacts that we have at other lenders who aren't yet accredited, and the majority of them are going through the process, so we can expect more to be coming out in the next week of being accredited. So if you are banking with somebody who isn't on the list yet, I'd have a chat with your relationship manager and see if they might not tell you, but I think the majority of people are looking to be accredited. As Matt alluded to as well, there's a new loan scheme that's come out. It's called the Bounce Back Loan. It was released today. I did a post on it last week on LinkedIn. There's slight nuances with this, is it's up to a maximum of 50 grand or 25% of your turnover. So as long as you've got 200k of turnover, you'll be able to get the full 50 grand. It's more no questions asked, sorry. So you don't really need to do a forward-looking forecast or anything like that. It's 100% guaranteed by the government, so hopefully that should mean that the banks are able to pump that out a lot quicker than CBILS. A few other bits, it's still interest-free for the first 12 months and no fees, and the interest rate is set at 2.5%, so it's a lot lower than what we've been seeing for CBILS, and it's fixed at that amount. So that won't change. And if you have taken out a CBILS loan of 50 grand or less, you can convert it over to the bounce back loan, as long as you're with one of the 10 accredited lenders. There's only 10 who are doing the bounce back loan. It's the main high street banks, being NatWest, Lloyds, Barclays, Santander, HSBC, etc. All this can be found on the British Business Bank. But overall, there's a lot of stuff coming out, and they're trying to make it easier. to get access to monies, but it's, you know, getting anything more than 50 grand still takes its time, and we're seeing that with the clients we're helping, although we're getting close on a fair few to getting some larger chunks than the 165 average. So
cool, that's good. And I think you know, the bounce back, coming back to, I think PJ agreed that the government's, you know, trying to make the money flow, and they've worked out CBILS doesn't work, you know, isn't working as effectively as they would like. I think, PJ, I don't know if you've heard, you know, my instinct would be that there could be a, you know, we've bounced back, hopefully it will work, that the limit might well be increased to 50 or you know, who knows, maybe 250,000, because the 250,000 seems to be a magic number that CBILS floats around as well.
Correct, yeah, it might go up to the 250,000 because there's no personal guarantees required for the 250 grand on CBILS. So I think they put it in at the 50 grand. I think it's to try and, you know, get it out there into the hands and get it out there quickly, because, you know, 50 grand is less than the average of CBILS, and there is no kind of due process with the bounce back loan. It's kind of, you apply for it, and as long as you've got the turnover there, I think you pretty much get it. So they might increase it as time goes on, depending on how businesses start to fare and what everyone is demanding.
Yeah, and you mentioned there, just for those who may have not been on our earlier webinars, in terms of the actual, you know, the cost of CBILS, what sort of costs are we seeing out there from the different banks?
So we're seeing a range from the high street guys. It's around the 3% mark over base, which is pretty much nothing at the moment. But so the last one I saw came through was 3.25%. That being said, some of the other lenders on there that aren't a high street bank, we're seeing almost 7% quoted. Then I think it's basically being done how they would normally price up a cash flow, a typical commercial cash flow loan. So it is lender specific, and they do have the free rein to charge whatever they want to a certain extent.
Cool, excellent. And you know, and in terms of any tips for any businesses looking to apply who haven't applied, any golden nuggets for them, PJ?
The key still seems to be around the forecast and nailing that, and really highlighting what the assumptions you've put in. So I got off the phone with a relationship manager at Barclays at the back end of last week, and after we sent over the forecast with all the assumptions, it actually called me up to thank her, because it was the clearest one she'd seen, and it basically answered everything that she needed to put into her credit report. So made her life very easy, and she was able to submit it, you know, pretty much that day. So I think it's trying to be as clear with as much detail as you can. That's the key to getting your application through as speedily as possible.
Cool, brilliant. Well, thanks for that update, PJ. I think we have got the Q&A open, so you know, if there are any questions on CBILS, please do send them over. If we don't have time to answer them in here, we'll try and get back to you, especially if you put your name on it. We'll get back to you, you know, separately. I'll drop you an email or give you a call later on this afternoon. So thanks, PJ. So on to our sector, our grandly titled, if I get the full title here, the Buzzcott Sector Valuation Insight Reports, which three of the team have been working on over the last 3-4 weeks. Instead of saying any more, I'm going to pass over to Andy. I think, Andy, you're going to pick up on this and give us an outline of what the report covers and why we prepared it, as well as jump into some of the details. So over to you, Andy.
Yeah, so I think this has very much come from part of what Matt's been showing everybody to the last few weeks, which is, you know, what could be happening with valuations. I've talked about valuation a couple of times, but actually when you start to look beyond the macro level of the whole FTSE, as Matt said, you know, how representative is it? It's actually starting to break down into the sectors to get a much better idea of how sector by sector the trends are actually moving. Now, why is this relevant right now? There aren't many deals going on, so we're not so much doing this for actually you're looking to transact in the next month or so, but it's more a case of we have many ourselves where people were in deals or have been close to thinking about selling, and what the potential impact could be for valuations for the second half of the year. Trying to consider and let people know, are you in a sector that's hard to hit right now, or actually are you more resilient, and therefore maybe actually those plans can still go ahead. There's also the other side of it, which is, and we've done a couple of webinars around various places around buy and build and acquisition strategies, and a number of clients have been thinking about, actually, can we go on these buy and build strategies, buy up businesses that might be struggling and buy them up on the cheap. So this is a thought, and again, I'd probably say, right now is maybe not the time to be jumping into it, but in the next few months, it's definitely becoming a valid strategy to think again, are you in a sector, especially if you're performing quite well, that actually could pick up businesses on the cheaper side of things. So Mira and Hamish are both here with me, both also be involved in pulling this together. So we're going to start going through just a few of the insights, and we'll be sharing this, as Matt said, this report later on in the week. Anna, if you don't mind jumping back to the summary slide. Sorry, it's backwards, I think. So what we found out the back of this, if you go back a couple of slides, Anna, what we found out the back of this is that actually there's a couple of sectors that have been a lot more resilient than as one might expect. So technology and healthcare, probably very obvious, that they show fairly strong, robust numbers. Mira, Hamish, do you want to delve into a little bit of the detail on those?
Yeah, sure. So if we start with technology, they've kind of been the most, along with healthcare, the most resilient, really, of all the sectors. And I think that's mainly down to the fact that they can facilitate this stay-at-home economy. So, as an example, Microsoft announced, a massive surge in its Teams usage. Now they're all working from home. Applications like that are kind of on the up, and kind of other subsectors. You're looking at gaming, people at home looking for stuff to do, massively up, well, not massively up, but in comparison with the rest of the market. And along with that, cloud-based businesses are also performing pretty well.
And I think that's a key point, isn't it, Hamish? That actually within technology, there's actually a lot more of, if we can just keep on that slide before, Anna, there's a lot more variation actually than in some other sectors, where you've got some who are up 30-40% compared to where they were before, but then there's others who are suffering badly. And I think that's partially because technology does cover a lot of client bases. Actually, a lot of businesses doing very different things. So you can see lots of variation in there.
Yeah, and I think another one where you saw sort of similarity in that respect is retail. So obviously for those that are relying on footfall in stores, they've seen a massive hit, and where their sort of online offering hasn't been up to scratch, or not a significant part of their revenue, and they've really struggled. But actually, if you look within the subsector, again, as you mentioned, the technology, there's a few different trends there. So some of the more sort of luxury brands that you can see in terms of businesses like French Connection, for example, are actually performing quite well out of this, in the fact that they're up compared to where they were sort of 6 months ago. And then similar to dealing with the fact that we're all at home, whereas the demand moved to, or even more so, gaming. I know we have a couple of keen gamers within the team ourselves, so that's where businesses are seeing more positive outcomes in terms of their valuations. And actually, some of our clients who are more focused on online retail are doing pretty well, so long as supply chains haven't caused an issue, depending on where those are. And actually, businesses we know in that sector are considering fundraising at the moment. So I think that's a kind of positive subset story of the retail market, where on first look, it being down 27%, doesn't paint the greatest picture. But I think you do need to look at the specifics of each company to really understand that.
Yeah, and I think it's definitely something that we've had a look at throughout the course of this in most sectors. You know, there are some where there's a lot more uniformity. You know, recruitment's definitely one where I think the impact's been fairly uniform across all businesses. There is just less hiring going on right now, but actually within most of these sectors there are winners and there are losers, unfortunately. But when you look at it on both a mean and a median basis, what we presented here is the mean of the difference. But even on the median, the majority of businesses are down. It is just a case of the varying levels of which we're seeing that impact.
Yeah, and I think those businesses with multiple service lines are kind of more defensible in this climate. For example, Apple released their results last week, and whilst direct sales of their handsets were down quite a lot, the use of their services, so their applications, seen a massive spike in demand. So if you've got different services that are able to kind of service different customers in this market, then you're a lot better positioned to survive.
Yeah, and I think it's similar for any business that's, who we're seeing do well out of this, and that goes for sort of whatever stage of the market you're at. These larger businesses that are listed, but equally the entrepreneurs that we work with and the owner-managed businesses, it's those who are agile, those who haven't necessarily set themselves up to not be able to adapt in a situation like this. Those are the ones that are doing well. So even if you look at, say, media, for example, the businesses that the more traditional businesses who have been reliant on ad revenue from, say, John Lewis, who are now changing the way that they spend their money, aren't going to be succeeding out of this, because but actually what should be happening is the fact that video content, us all sitting at home and looking at video even more, and given we can't attend events, we're moving to video as a medium even more. The businesses that are able to adapt to that and meet those demands are the ones that will be doing well, and those are the ones, if you're thinking acquisitively, where you should be sort of focusing your attention on, even in the case where a business might be sort of under duress, it's still understanding, is this an agile business? I think that's a really interesting point you've seen in the numbers.
Yeah, and look, all this is very much subject to flux at the moment. You've seen from Matt's chart earlier, the level of variance that's happened in the market as a whole. The spikes within these sectors mirror that, and in some cases more extreme as well. This is not only a reflection of the impact of what's happening to businesses right now, very much the way the markets work. And what we've done here is we've looked at the list of businesses because there's immediate data off it, but you would very much expect the parallels to be drawn to businesses within these sectors that are non-listed. Is the expectation over what will happen in the coming months and the future profitability. These numbers, and what we're planning to do is track these over time to actually be able to see what the impact is, because my gut tells me I think there will be some sectors here which perhaps actually will learn more and have been overvalued right at this sector's second, but there are some that will be undervalued. So while this is what's happening right now, very much if any of you thinking about making acquisitions and have your own thesis, your own idea about what might be coming up, and you actually look at one of these sectors and think, you might be in leisure and you think there's some great opportunity there, because let's be honest, it probably will be a while until that sector gets completely back to normal, but you think that's too much of an impact, then that definitely should be an area that you're just thinking about in the back of your head, whether that's expanding organically or whether it is making acquisitions. So there's very much opportunities out of the back of this. It's not purely about there being a negative impact on valuation.
Brilliant, and thanks for Andy. And I think it's Anne-Louise, and thank you for producing this webinar, Anne-Louise. Back, would it be possible, Anne-Louise, just to flick to the back end of the report, just to pick up on the data sets, because I think, Andy, one of the the important points, contrasting with what might at macro look, what you guys have done is looked at, I suppose, the specific valuation comparators that we might use in those sectors if we were doing a valuation report or helping with fundraising. I think it's just useful just to just and if you just got 1 minute, just dwell on exactly how we've come up with the the variances that we have done. Hopefully Anne-Louise will get to the back end in a second.
Yeah, so the way we've looked at this, we've taken quite a large data set. If Anna keeps flicking through, you'll see through some of the size, the number of companies we've got here. One of the key points has also been that we've looked for any differentiation between the larger corporates above 500 million of revenue and those below. So thinking about below, think of very much markets such as AIM. This is a global view as well, so not UK specific. But the reason we look at a global view very much is that a lot of our transactions happen with overseas buyers, whether it's from the US or whether it is from somewhere like Asia. So very much, I think, when looking at valuation, one can't look in a country silo. You need to look on a global basis. The approach we've taken is to look at the mean movement across businesses. So this is not a movement in market cap. So Matt's graph before, which is showing the movement, that is the cumulative market capital of the FTSE and how that shifted. What we've done here is we've looked at the movement of each individual company and then taken the average of that. So hopefully that should give a better indication of what's really happening to the average business within this, rather than skewing due to the performance, which is, Hamish mentioned one or two very large companies there, which might be stacking up quite well, that can skew the market. So we hope this gives a fairly true reflection of the market, although of course you can cut and slice and dice the data in lots of different ways.
Cool. And what we're aiming to do this on a relatively regular basis. I think we've rushed out for this morning because I think the last data set, Andy, was the end of April. Is that yeah?
So all these numbers are as at the end of April. So I think our current intention is we'll probably aim to do another one at the end of May, so that we can contrast what happens over the next couple of weeks as there's more details around easing of lockdowns and some of the European countries have started trialing theirs.
Brilliant. Well, thanks for that. And I said that the report that Anne-Louise has flicked through on the screen in the background, right at this second, it's draft. But what we hope to is to be able to properly publish it as soon as we can do this week. Cool, brilliant. Well, thanks, guys. That's looking really good. So as we just got a couple of minutes left, we have had a couple of questions on CBILS. PJ, I think I'll fire one of them at you. Yes, I don't know if you've got a view, especially on the bounce back, and indeed on the main CBILS. If your lender isn't on that list, what's our advice? Is our advice to try and find another lender, or to wait for one's lender to be added to that list?
So most lenders are only offering this up to existing clients. That being said, that is changing. So I think over the last couple of weeks, I think Santander and NatWest have both come out and said that they'll start to consider new businesses coming on board. There's also the likes of Funding Circle, which is a peer-to-peer lender, but they're offering CBILS monies up to new businesses as well. So I think you're going back on what we said maybe a couple of weeks ago, which was, you need to stick with your current lender. I think the marketplace is changing, and definitely to try and start to explore other avenues. That being said, the path of least resistance is to go through your current bank. But if your current bank isn't offering it up yet, you can always approach them as soon as they get accredited. But that might be a way, as I said to you earlier, to elicit some information as to whether they're going to be accredited soon or not, if you have the conversation with your relationship manager. But I think that the marketplace is opening up to have conversations with new lenders.
Cool, brilliant, excellent. Thanks, PJ. As we're all out of time, I think move on to the close. So before we go, another thing that we are doing is we are running a survey out there. I think we're pumping it out mostly via LinkedIn. Mira, do you want to say 1 minute, 30 seconds, 10 seconds?
Yeah, absolutely. So what we're hearing from entrepreneurs is, it is the most insightful thing is to understand what how other entrepreneurs are reacting, what actions they're taking, how they're feeling, and that is to us sort of drilling down. We had the macro level, what Matt was talking about, our kind of insight into valuation data, and this is, you know, the one step down, drilling down into actual sentiment of businesses in various sectors of different sizes, and so that you can hopefully understand off the back of that some useful thoughts there. So it takes 4 minutes to complete, quicker if you're faster at reading than I am. So it closes this Friday. So we've already had a number of people respond, but it'd be great to increase that amount. So the link's there. I'll also post it in the Q&A as an announcement. Cool. Thanks very much, Alex.
And is that website as well, Mira? Is it? You know.
Say that again, sorry.
Is that link on our website? Is it?
I believe it should be, and we'll also have it on our mailing list sent out. So I'll post the links there. Okay,
cool. Brilliant. Well, that knows we've run over slightly. I think I thank as ever, thank the team for their contribution. Thank you for watching. Do keep asking us any questions whatsoever. You know, we are here to help. Done 6 of these, and I think the the clients and the contacts inside Buzzcott that we speak to do value these. Very happy for any input from anybody as to any topics that might want to be covered over the coming weeks. But so we look forward to hearing from you. But on that note, we'll say goodbye and look forward to seeing you again next Monday. Goodbye.